Good morning, everybody. If you've been a regular viewer of the show, you'll know the format here that we always just sort of run through the week's news in the sector first, and then we normally interview a fund manager. This week, slightly differently, we're going to have a panel of three to talk about a topic that I think is quite important at the moment, which is whether markets have changed direction. But before we get there, let's just run through the week's news. There's a little bit of that to do. I've brought up the slide here so you can see the four funds we're going to talk about. Let's kick off with Aberdeen Property Income. Now, this is in the news because it's been the subject of bid talks. So it's got bids from Urban Logistics and Custodian Property REIT. And you can see that despite that, it's still trading quite a big discount to net asset value. It's a decent size, around about 200 million, but that's quite small in the property world. On the 20th of March, Urban Logistics said it would not proceed with its offer for Aberdeen Property Income. So that meant that the Custodian REIT offer was now the only one on the table. And the share price of Custodian REIT dived. That matters because the offer, basically, there's no cash option in this. Basically, all you get is Custodian REIT shares, 0.78 Custodian REIT shares for every Aberdeen Property Income share. Now, in terms of the net asset value, what that means is where you had an NAV of 83.8p for your API share, you're now going to have 0.78 of 94.6, which is 73.8p. So you've seen quite a big drop in your NAV because of this. And this is because the whole thing is set up because they're doing a transfer value from API shareholders to CRI shareholders as a way of getting the Custodian REIT shareholders to say, yes, we want to do this. And they have voted already, and they've already said, yes, we want to do this. Not that surprisingly. If it all goes through, even on the current low Custodian REIT share price, you would get a little uplift in value. You can see there 52p, 54.8p, so about 5% uplift. But if you reject it, then the board says it's going to propose a managed wind down. Now, on the 20th of March, the fund said it sold two properties for £16.5 million, which is a very small discount to NAV. The board quite pointedly has come out and said that's not what you get if we did a managed wind down. They are really pushing the Custodian REIT option, and I'm not sure why. If you could sell the portfolio at NAV, and I'm not saying you could, but if you could do, you'd get more than 50% upside as an API shareholder. If you sold it at 20% discount to NAV, which, you know, that's quite a big haircut, you'd still get a 23% uplift. So I think on the way that the numbers have all moved at the moment, it's a slam dunk. You should just say no to the Custodian REIT offer and opt for a managed wind down instead. As I said, that's not what the board's saying. I don't know why that is, but it seems daft to me to destroy value by going through with this deal. Now, Hypnosis. We talk about this every week, it feels like, and I didn't really want to do this again, but here we are on a massive discount because a lot of things have gone wrong. And then on the 18th of March, it came out and said the NAV that they've been published has been double counting the accrued income, which is a massive, massive failing. That meant that they've had to take $110 million off the net asset value. So that's a 7p drop in the NAV per share. Turned out the board had questioned whether things were being calculated before, but had never said anything to shareholders about this. And the investment advisor says it now agrees that the board was right, although it might have said something different before. And the board's pointed out that that means that because the market cap's heavily influenced by the what the NAV is, it's almost certainly been overcharged fees by the investment advisor. And the big thing, obviously, is that we've all been buying and selling shares in this thing based on the wrong NAV, which is, you know, terrible. So, I mean, the auditors have a massive question to answer here, I think. You know, how could you audit this more than 1 year and not spot this? It does come back down to who's ultimately responsible for this. I mean, clearly the board is responsible for publishing the NAV, and at the end of the day, it and the audit committee of the directors should have picked this up before and really pushed to get a proper answer on this. I think we now got a situation where we've got another fund where we could see a lawsuit against the company. I'm a shareholder in this, and I'm thinking I might sign up to it. So there we go. Scottish Mortgage, a bit of announcement this morning, which caused some excitement. That was last night's close. The discount was 7.9%. It's about the sort of 12 billion market cap company. As we know, it's one of the biggest funds in the sector. We talked about it last week because they're going to buy back at least £1 billion worth of stock, which sounds like a huge number, but it isn't even 10% of the share capital. And I did question whether that would be enough to sort the discount out, but actually, the discount moved quite aggressively almost straight away. If you go back to the thing, you see that little spike up there. It did narrow quite aggressively. I also question whether if the market fell, would it be forced to suspend its buyback, because there's lots of things that are going on with the gearing and the proportion that it's got in unlisted stocks and things. If you want to know the ins and outs of that, go back and watch last week's. This morning, it turns out that this activist investor called Elliott now owns 5% or over 5% of Scottish Mortgage. It doesn't really own it. It's got less than 0.5% that it owns directly, and the rest is held through contracts with various brokers or banks. Nevertheless, that gives it sort of the rights to buy this stock, which is about a sort of £600 million investment if they actually put the money down and convert it into a direct holding. I'm guessing that, although they saying they went through this thing on the 19th, they actually tell the market until the 21st. They're already sitting on a decent profit. The share price is up another 1% this morning. So the question now we have is, why did the board announce the £1 billion buyback? Was it because it knew that Elliott was there building the stake? What's Elliott up to? We have no idea. Could they be trying to force something through on a kind of governance basis? Remember, there was a row last year about whether the board knew what it was doing, investing in private equity. And you know, has the company got too overexcited in buying private stocks? I think that'd be a slightly strange thing for it to do, because it's sort of like one of these fights that might not make him an awful lot of money just to getting that sort of thing sorted out. The normal approach to this thing, which you're an activist investor, if you sort of hedge out the underlying, so you don't have to put up too much money up front. So you basically buy the shares and sell the underlying portfolio. You can't do that with a lot of the Scottish Mortgage portfolio because it's unlisted, so it's not really hedgeable. So they are sort of exposed to what happens with those holdings, and the question must be, is this just a bet on recovering those growth stock valuations, which is really what we're about to talk about in a minute? Or it might just be that they've sort of playing this for ages. When it was on a 15 discount, they've gone through the number, they've announced it, and now they're already selling the shares. We won't find out until later. One last one. We've never had a situation before where we've had a bit of news on somebody who's on the panel, but we do. So we had results from Witan this week. There's the numbers there. Dividend went up again, all good. And the big news, and maybe James will allude to it when we're talking later, is that the CEO is going to step down. And that means the board have launched a review of its management arrangements. So that's very sort of early days in that story. So there we go. Now, I need to stop sharing. How do we do that? I think I just want to go. Hang on. There we go. Well done, Eamon. I was getting stuck with the technical stuff. I should have thought about this before. Good. So if our panelists could all turn their screens on. And then we're good. Thank you very much for doing this morning, gentlemen. It's really good to see you all here today. Now, the point of this, the reason that I wanted to chat to you all is to talk about really what's going on in markets and what that might mean for investors. And it really sort of predicated, if we went back to the early part of last October, markets were slightly panicky that rates were still going up and inflation was still going up and things were still out of control. And then about the middle of the month, it became obvious actually that US inflation was starting to look like it was going to come down and under control. And there was talk about rate cuts. And lots of things kind of turned on a dime then. So bond yields started falling. Interest rate expectations fell quite a lot. There was a sense that interest rates had peaked, and growth stocks started to bounce. And we've had a lot of jiggling around since. But really, I want to sort of tease out why markets moved the way they did on that news and how that affects your portfolios. But before we get there, maybe we just get you all to introduce yourselves. So if we start with James, can you sort of like say a little bit about who you are and what fund you are running, please?
Yeah, absolutely. Thank you, James. Thank you for having us on the show today. I am James Hart, Investment Director at Witan Investment Trust. I work alongside Andrew Bell, who, as you just pointed out, is the CEO of Witan and has signaled his intention to retire this year. I won't go into detail on the announcement, but obviously, if there are some questions, I can answer very high level, give very high level answers because it's a very early stage in the process, and it would be wrong of me to go into any specifics at this stage. Witan is a global equity investment company. We're self-managed. My team and I, there are 6 of us that work for Witan. And we outsource the stock selection within our portfolio to 7 or 8 outsourced managers, each of whom has their own sort of specialist area that they focus on within the global equity market. We also invest in some more special situations, either through specialist managers or through the investment company sector. And I'm sure we can come on to talking about how markets have impacted our managers positively and negatively, as well as our investments in investment companies. But that's Witan in a nutshell.
Great, thank you. Nish, over to you.
Good morning, James. Morning, everyone, and thanks for having me. So my name is Nish Patel. I work at Columbia Threadneedle Investments. I have 17 years of experience in investing in small cap equities, mostly in developed markets. I'm the joint lead fund manager of the Global Smaller Companies Trust, which is a London-listed investment trust with 875 million of assets invested in smaller companies globally. We take a long-term conservative approach to investing in good quality growing businesses, and we do this in an opportunistic way, i.e. we look to buy into these quality businesses when they're available at an attractive valuation. We do have a good long-term absolute and relative performance track record, and we pay a dividend as well. We've raised our dividend for 53 years consecutively.
Thank you, Nish. And lastly, Jonathan.
Hi, I'm Jonathan Brown. I manage the Invesco Perpetual UK Smaller Companies Investment Trust alongside Robin West. We look for good quality growing businesses. We look to acquire them on sensible valuations and then support management teams in their growth aspirations over the coming years. The trust is interesting for people with an income requirement. We pay a 4% annual dividend yield. And so you can gain the growth that you often find within UK smaller companies along with a nice level of income. We've got a very good long-term performance record. And it's a relatively simple proposition, but we think it's a very undervalued and quite exciting area of the UK market.
Thank you. Now, a little bit of economics. I don't want to get too technical here, but James, maybe, do you want to sort of try and explain to our listeners why interest rates matter and actually what impact interest rates have on your portfolio?
Was that directed to me, James?
Yes, please. Yeah.
Yeah, absolutely. Well, I mean, one of there are a few different impacts that interest rates have on an equity portfolio. The first is obviously that it gives people other options. If you're and a lot of the improvement in valuations in the equity market when interest rates were extremely low was down to the fact that people were searching for other sources of revenue when they were getting nothing on deposit and very little on their bonds. And so the so-called bond proxy stocks, these are sort of consumer staples and the like that were delivering dependable dividends, became extremely popular as a source of revenue for retail and indeed for institutional investors. And of course, when interest rates go up, people get more on their savings and they get more on their bond investments. So it's more of a competition for capital. But more importantly than that is equity investing is a stream of future revenues. And the higher the interest rates are, the higher the discount rate that you use to discount those future revenue streams, and so it affects the valuation, particularly on what are called long duration assets. So these are the sort of growth stocks that you were talking about in the introduction, where the likelihood is they're going to grow earnings over the long term, but you might have to wait quite a long time for that, so the value of those future earnings declines. So I mean those are the two key influences on equities when interest rates go up.
Great, thank you. Nish, perhaps you could say, do you think that interest rates have turned, I know they haven't actually moved yet, but do you think the next move is down? And how fast do you think that's going to happen?
Yeah. Well, it's interesting because after the inflation data that came out in October, I would say that the initial market move was quite aggressive. I think the Fed, the sort of expectations of interest rate cuts for 2024 went up to something like 7 interest rate cuts. And I think that initial move was a bit too much. And in January, we had a broad realization that maybe inflation will take a bit longer to come down than people think. And now we're between sort of 3 and 4 interest rate cuts for this year, which is somewhat more sensible. What I would say is that the risks are that some of the factors that led to low levels of inflation in the recent past are reversing. So, for example, we did benefit from globalization, and that seems to be reversing now and getting deglobalization. We have populist governments now, and the bargaining power of labor is increasing, and that means that wages are likely to stay a bit more resilient. So these are sort of factors that might mean that inflation could be a bit more sticky than we think.
And then, Jonathan, I mean, I think the trigger in what happened with markets in October was a lot around what was going on in the US. But obviously, we're hoping, I know the Bank of England left rates on hold this month, but we're hoping that we're going to get a shift down in rates here in the UK too after the inflation numbers. Which does it matter still what happens in the US, or is it more about UK for you?
The US does matter. The impact that Fed decisions have on the US market, you also see that reflected in valuations of UK businesses. So it does matter. And I mean, my guess is that the Bank of England will be reluctant to cut rates before the Fed. I mean, we'll have to see on that. I mean, if there are predictions that inflation could dip below 2% over the next couple of months come true, then will be, to have 5.25% base rates, given the level of economic weakness we have at the moment, would seem quite surprising. So yeah, America does matter, and but I mean, my best guess is that rates will start to decline as we move through the balance of this year and through next year. But of course, you have to remember that the rates aren't unusually high at the moment. It was just a period post the global financial crisis in 2008. It was an unusually low period for interest rates. So I don't necessarily think they'll come down dramatically, but I think there should be a move in the downward direction.
And there's a question actually, obviously people, please do put questions in the Q&A and they will get fed through to me. And there's a question maybe for Jonathan already. So with the recession in the UK that we've got now, do you think that inflation might shoot the other way? Do you think we might actually see some deflation?
I mean, a lot of it comes down to energy prices, really. And a lot of the inflation that we saw over the last 12 months or so was due to, gas bills going up, but also the cost to businesses going up as well. Most businesses use energy in some form, so it feeds through to all areas of the economy. And we've seen, particularly with gas prices, not so much with oil prices actually, the gas prices have now fallen to below the level they were immediately prior to the Russian invasion of Ukraine. So that is exerting quite significant downward pressure on certain areas of the economy. But I'm not convinced we'll see deflation. Maybe we will briefly, but we're still seeing wage settlements in the UK. If you look at the minimum wage, that'll go up by 10% next month, and there'll be a knock-on effect elsewhere in the economy. And although speaking to businesses, we've gone from pay rounds of 5, 6, 7, 8% over the last 18 months to 2, 3, 4%. That still means that they're going to have to raise prices to cover those additional costs. So I think inflation will moderate because of the year-on-year effect. It could potentially dip down into a negative number, but I don't think that's where it settles.
Okay, thank you. Jonathan mentioned falling energy prices. James, have you got much exposure to energy stocks within your Witan portfolio, and are you changing the exposure because of that?
We have got very little direct exposure to energy stocks within the Witan portfolio. Typically, it's been around about 3%, which is less than our benchmark, sort of materially less than our benchmark, about half a benchmark weight, to be fair. Our managers who are our asset allocation is driven by the stocks that our managers buy, who are all bottom-up stock pickers, active managers. So the resulting asset allocation is the result of the stocks that they select. And particularly in the wake of the Russian invasion of Ukraine, they did increase materially their exposure to energy stocks. So at one point over the last 12 to 24 months, we've been up to 5.5, nearly even 6% in energy. This is direct energy, oil and gas. Whereas now it's much closer to 3 again. So very, very small weighting. We do have indirect exposure because we have an investment in a climate change strategy, which had an awful time last year because with higher, and it goes back to what we were talking about, the impact of interest rates. With higher interest rates, people are building out fewer renewable energy infrastructure projects. So the demand for those sorts of products was declining. But that does give us we noticed that there is quite a lot of close correlation between the way in which those assets perform and energy, traditional energy performs as well. Okay,
cool. Thank you. Nish, obviously you're a small cap strategy. Do interest rates have a sort of disproportionate effect on small caps relative to large ones?
I think they do. The reason why is that they are more dependent on financing, particularly from banks. They have less ability to go to capital markets and to get their financing. So there is quite a tight relationship between high yield credit spreads and how small cap equities do generally. We prefer businesses that have got good balance sheets, and that's been part of the way that part of our focus over the last couple of years is to focus on businesses with really good balance sheets and that are cash flow generative. Because if we are in an instance where interest rates are higher, potentially for longer, then we want businesses that will be able to take market share in that type of an environment. And if you've got a good balance sheet, then that certainly helps. But I think it's fair to say that, yes, smaller companies are disproportionately affected by higher interest rates.
Do you think your markets are expensive at the moment?
I think the opportunity in smaller companies is much better than the opportunity in larger companies. If you look at the relative valuations of small caps versus large caps, in the US, for example, smaller companies are 30% below the valuations on a relative basis versus larger companies, which is really attractive. And smaller companies have been laggards for the last 10 years or so. It's been all about the Magnificent Seven and the S&P 500. But it's strange in the sense that over the long term, smaller companies tend to outperform because they tend to generate faster earnings growth. They tend to be undiscovered. And as the investment community realizes the merits of these companies, the valuations tend to expand. So we're in this strange situation where you've got a fundamentally good asset class that's very undervalued relative to the large companies. And we think there is a potential for smaller companies to catch up to larger companies. The question is, what's going to be the catalyst for this? And historically, actually, the first interest rate cut has been quite helpful. So since, I think, the 1950s, in the 12 months following the first interest rate cut, smaller companies outperform larger companies by about 10 percentage points. So we do think that it is a really good time to look at the asset class because we may be getting the first interest rate cut in the US in the middle of the year. So we are excited. There is a very good opportunity here.
And Jonathan, I think in the UK, there's a sense that UK small cap is particularly unloved, and particularly, is that your sense too?
It is certainly from institutional investors and international investors as well. It's an asset class that's often underweight in people's portfolios. And again, as Nish was saying, when we look at valuations, the valuation of the UK small cap sector is considerably below its long-run average. So we do think that valuations look particularly cheap at the moment.
James, what's your sort of exposure to the UK as a kind of your global portfolio? What's your percentage of exposure to the UK, and are you thinking about increasing it or not?
Yeah, well, before I answer that, I just wanted to add something on the your previous question, which is, I think as global investors, we've got to remember that we sit here in the UK and we talk about small caps, but if you're sitting in the US and you're looking at the UK market, some of the FTSE stocks are small cap stocks for them. So FTSE 100 stocks are small cap stocks. So we've actually got a double whammy here in the UK. They don't like the UK. In fact, it's even worse than that. They're ignoring the UK. And there's nothing worse than the only thing worse than being hated is being ignored. So they're ignoring the UK and they're ignoring small cap, and so it's a double whammy. And I totally agree that the market has been driven for a while now by the Magnificent Seven. But actually, if you look at it over the last few months, particularly this year, that has broadened. We've seen less of a geographic influence on market performance, and the market performance appears to be broadening. So I think that's a positive sign for investors that are focusing on areas other than the mega cap tech names in the US. Coming back to your question about the UK, we actually have in our benchmark, we have a kind of a hybrid benchmark, which is 85% global and 15% UK. So we naturally have a higher UK weighting than many of our peers. At the moment, it's around about 17%, which is pretty much in line with the benchmark. That is largely driven by a couple of our global managers who have chosen to buy UK stocks, particularly UK mid-cap stocks, interestingly. They're seeing an awful lot of value there. I suspect they're right, but it certainly is taking some time to come through in terms of realizing the potential for some of these companies. But in addition to that, we have recently invested in a FTSE mid-cap ETF. A small amount, a couple of percent of our assets, because we believe that the opportunity is there as market performance broadens away from a narrow focus to a broader focus, that the UK will finally start to benefit from that. And the great advantage of buying the FTSE mid-cap ETF is it's 35% invested in investment companies, which themselves are incredibly cheap. So there's killing two birds with one stone there, a bit of UK equity exposure and also some exposure to investment companies. But around about 70%. It's actually pretty much in line with where our benchmark is.
Okay, great, thank you. There is actually a question here that's saying, and maybe I'll direct this to Jonathan, but apparently the boss of Santander said this week that return on capital in the UK was worse than elsewhere. So other than the UK being cheap, is there another reason to invest in the UK?
Well, I think if you read the headlines, you think it's all doom and gloom economically in the UK, but I don't think that's the case. I mean, we have full employment. The economy is broadly stable. When we look at consumer balance sheets, they're in a better state than they've been in for donkey's years. So the money is there for people to go out and spend. I think what we need is just a bit more confidence. And certainly when we look at some of the economic indicators that are used to predict the future direction of the economy, so things like the PMI survey, which is a survey of purchasing managers, that looks quite encouraging. That's suggesting a return to economic growth. So we don't think, I don't think the economy is necessarily in as bad a state as many people would believe. So I think we can return to growth, and I think that combined with low valuations, is quite an attractive cocktail. Okay,
thank you. Got some more questions coming through, but let's talk about a bit more about underlying portfolios. And maybe Nish first. So what sort of, I know you've talked about quality stocks that you hold. Mm-hmm. What's a typical stock in the global smaller companies portfolio, Nish?
Yeah. So when we say quality businesses, what we mean is that companies with really strong competitive positions that are profitable, that have got little debt, that make earnings today, not at some point in the distant future, which is what you get in a lot of small cap equities. More recently, we have been buying businesses that we think will grow reliably, whatever happens in the macro. So an example of this is Domino's Pizza, which is a very strong business in the UK. It's a market leader. It's got 40% market share in the pizza delivery business. It's almost 3 times the size of its nearest competitor. We think this is a really good business because it's a franchise model. So the growth in the stores is funded by the franchisees. And the group company, which is the company that's listed on the London market, is providing its franchisees with the ingredients. And as the business grows, the marketing budget tends to grow. So there's almost like a virtuous cycle going on. A few years ago, the company ran into some problems with its franchisees. There was a management change, and the growth started to slow down a bit. Last year, we met the management team, and we got the impression that a lot of those issues were being addressed. They had just signed a new partnership with Just Eat. They have a new agreement with their franchisees, and store openings look like they're picking up. And we were able to buy this business at 14.5 times earnings, and it's traded on over 18 times in the past. So this kind of shows you that our approach of investing in really good quality growing businesses, and we look for these opportunities or blips in the road to buy them at good valuations. And so that's something we've been excited about. We are also finding good opportunities in cyclicals. These are very depressed businesses at the moment because the industries might be out of favor. So, for example, in industrials and in housing, there are a lot of companies that are facing headwinds because, as Jonathan said, the ISM and PMI data has not been very good recently. But we think that these companies are at the end of a destocking cycle, and there is potential for mean reversion as the PMI start to pick up and organic growth starts to pick up and operating leverage comes through. The earnings growth will be really substantial at some of these businesses. And they are backed by longer term trends that will be helpful for the manufacturing sector. Things like reshoring, spending on infrastructure, spending on defense by governments. This is all good for the industrial backdrop. And as mortgage rates come down, that's also beneficial for the housing market. We're likely to see more activity pick up in the housing market. So we think there's good value in that sector as well.
Okay, that's great. There's a specific question here. When you're thinking about growing companies, what sort of timescale are you looking at them on?
So when we start a position, we do our work on the assumption that we're looking 2 years out, but actually in reality, we really run our winners. And we have held things in the portfolio for over 10 years. These are particularly compounding businesses, which started off very small, but then have grown and are still not classified as large caps. So we do like to run our winners, especially if we're in a situation where there is abundant growth opportunities for them to invest their cash flows into high returning propositions.
Okay, cool. Thank you. Jonathan, do you want to sort of tell us a little bit about things that might have been added to your portfolio recently or things that you really like?
Yeah, I mean, we're running with what we call a barbell approach at the moment. So that's a mix of more defensive businesses. So, for example, we own a company called JTC, which is the Jersey Trust Company. And that has a lot more certainty over its future level of revenue than most businesses because it does things like the administration for fund structures. So these could be private equity funds or real estate funds. And these funds tend to last for several years. And so they've got visibility over future growth. And so in more difficult economic times, they can continue to grow resilience. Some of the portfolio in companies such as that. But also we're willing to buy cyclical or more economically sensitive stocks at low valuations currently as well. So for example, we've built a position in a company called Marshalls, which is known for selling things like paving slabs into the landscaping sector, etc. And the shares of this business have declined a very long way over the last couple of years. But we can see a return to growth in the UK, and that should benefit their earnings. And also, there are some additional benefits to the business. So they're a leader in roofing systems, and these are increasingly incorporating things like solar panels. And the newer regulations around energy efficiency in housing should significantly increase that aspect of the business as well. So where we can find a business that's fallen a long way, that's of good quality, but also has some additional growth kickers, then we're keen to take a contrarian position, even if short-term trading is a bit more difficult in those businesses. Great,
thank you. Inevitably, there's a couple of questions on AI. Maybe James, do you want to take that first? So firstly, you mentioned the Magnificent Seven already, but what's your kind of exposure to that kind of area, and do you think it's something you want to overweight or underweight at the moment?
Well, it's incredibly difficult to define AI in terms of exposure, but if you think about the stocks that are most commonly associated with the theme, and that's the if you like, the AI enablers. So, the likes of Nvidia, Microsoft, TSMC, etc. Sort of back of the envelope would probably be about 10% of our portfolio is exposed to AI stocks, which where there's an overlap with an AI benchmark. So, the companies that are typically defined as AI companies, so about 10% of the portfolio. And it's really clear that, 2023 was the year of the AI enabler. In fact, some research recently published by, I think it was by Morgan Stanley, suggested, and I'm not sure I 100% agree with this, but it suggested that if 2023 was the year of the AI enabler, 2024 is going to be the year of the AI adopter. So in other words, those companies that are using technologies to enhance productivity and become more efficient. And it certainly will be the case, but 2024 might be a bit early. But when you think of it on those sort of lines, you've got a lot of companies around the world that are, using AI. Companies like RELX, the UK business RELX, which uses AI in its legal, clinical, and indeed its research platforms. Sony, obviously Sony Entertainment in gaming. You've got United Health, the US insurance and healthcare provider. Even our very own Tesco. Tesco Clubcard has 20 million subscribers or something. It's one of the biggest databases in the UK. And if you could mine that data efficiently, then that becomes an extremely valuable asset for a company like Tesco. So all sorts of different ways of thinking about how AI impacts your portfolio, and how it might benefit in the future, but specifically about 10% in terms of the AI enablers.
Great, thank you. Nish, obviously this panel was sort of predicated originally about inflation and interest rates, but actually, do you think new technology like AI actually lowers inflation?
Oh, that's a difficult question, because inflation, forecasting inflation in any case is always hard. And there might be two schools of thought there, where, as James said, if you have AI, then that increases your productivity, and you're able to do more with less. And that you would argue that potentially that's deflationary. But then if productivity growth picks up significantly, then you could end up in an inflationary type situation. So I think the jury's out. As far as AI goes, it's really hard to say who's going to be the ultimate winner in this space, because technology is changing so much and competition will inevitably come in to the space. What we're doing is we're first trying to figure out, is AI going to hurt our companies or help them? That's the first question we're asking. We do have some exposure in the portfolio to AI, and it's mostly through the picks and shovels, if you like. So the semiconductor companies are a good way of having exposure there. We didn't specifically build the exposure in those companies because of the emerging AI sort of wave that has come out over the last couple of years, but we do have positions in BE Semiconductor and ASM International, both who create equipment that's involved in the production of complex next generation chips that are going to be needed for applications such as AI. And we have exposure to value-added resellers as well, which are companies that will advise customers on technology products and services, and that includes the implementation of AI. So it's a hard question, James. I don't think I have a clear answer in terms of, is it going to be inflationary or deflationary? I think the jury's still out on that one.
Fair enough, thank you. Jonathan, how does that AI affect your portfolio?
Well, AI has been around, or machine learning has been around in various forms for well over a decade now. So I think what changed last year was the launch of ChatGPT 4, I think it was, and the large language models, which I think have captured a lot of people's imagination because of their almost human-like output. Now, we ask all our businesses about this, and in most cases, they are looking at how they can implement this within their own companies. And on the whole, it's useful for quite menial tasks. You can take out some of the administrative burden from certain aspects of the business. I think companies hope they're going to improve things like chatbots, which I'm sure we've all been frustrated using in the past. If they can be improved, that will obviously enable businesses to remove a bit of cost from things like contact centers, for example. But it's for most of the companies we speak to, it's the impact on them is not particularly large. I think the companies where it is of most interest are, as James alluded to earlier, the businesses that are very rich in data. And although this is an iterative improvement on the kind of data mining processes that have been used for quite some time, it does increase the ease of use for a lot of data that these businesses have, and therefore should increase its value. And we own a number of businesses such as Global Data, which they provide information to businesses about the markets in which they are competitors. The use of these large language models will make it easier to extract information from the databases they have. So it's useful for those sorts of businesses. But I think we're at there's the old hype cycle that you get with new technologies, and I think at the moment the excitement is slightly outstripping the utility of AI for most companies.
Okay, cool, thank you. Now we're talking about growth really today, but how important do we think dividend income is going to be to investors' returns over the next few years, James?
Well, Witan runs a portfolio which is effectively a total return portfolio, so we don't really focus on one aspect or the other. We look for capital growth over the long run, as well as dividend growth ahead of inflation in the long term. Obviously we won't necessarily be able to grow our dividend ahead of inflation every year, particularly in years like 2020, 2022. But for me, and we've run it every year for 49 years, and so hopefully we'll get to 50 next year. But for us, in terms of when we think about appointing managers to run bits of Witan's portfolio, what we're looking for is the best possible total return. So we have some managers where the dividend yield is very low indeed, but they're focused on high growth companies that typically don't pay dividends. And then we've got others where the sorts of companies they identify are those sort of quality compounders, companies that generate sustainable cash flows long into the future. But fundamentally, as an equity investor, I like dividends. I think most equity investors, except for those that sit in the highest growth part of the market, like dividends, because more than anything else, it's a kind of seal of approval. It's a stamp of quality. If provided the company's not over distributing, of course, but it's a stamp of quality if a company can year in, year out deliver growing earnings and deliver a growing dividend to shareholders. So, but it's not clearly it's not the only aspect of equity investing.
Okay, cool, thank you. And Nish, you said you've got an even longer track record than Witan of consecutive dividend increases, but do you factor dividends into investment decisions that you make, or are they just sort of an ancillary thing?
I'd say it's more of the latter. It's an ancillary thing. We prefer cash flowing businesses. The UK, we have an overweight position to the UK. We have 25% of the trust in UK equities, and they have been historically generous dividend payers. What I do like about dividends and just shareholder returns in general is that it's indicative that the business itself is cash flow generative, and B, it takes away the decision making from the management team, because capital allocation is extremely difficult in any circumstance, and quite often you'll find management teams misallocating capital. But if they are actually being forced to pay it out to their shareholders, the chances of mistakes somewhat abate. So I think it's helpful from that perspective. Going forward, I think there's potential for dividend income to be more important, in the sense that if we look at the earnings profiles of corporates worldwide, margins look quite full. Corporate profit margins do look quite full in many regions. And the valuations have expanded significantly over several years in a lot of markets. The UK is obviously a market that is attractive from a valuation perspective, but if you look at, say, North America, valuations look a bit higher there. So what this means is that we might be a little bit more reliant on dividend income than we were on capital appreciation that we've seen in the past.
Okay, thank you. Jonathan, do you think investors should be looking at growth-focused funds now or income-focused funds?
Well, stating the obvious, I'd want to look at income funds. If you've got a longer-term investment horizon, then I think growth is more attractive. I mean, the way the trust that I run is set up is we pay a 4% dividend yield, and that's partly covered by income from the portfolio. But we also make a payment out of capital, and that means that we can target the businesses that can deliver the best total return, rather than having to focus on companies that have a high yield but may be deficient in other areas. So, we believe we've got quite an interesting blend of investing in businesses with lots of growth potential, but also delivering income to investors.
Okay, cool. There's lots of sort of slightly sweeping questions about, can you tell me why I should buy your fund in particular? And maybe we stick with you, Jonathan. What is it you think that makes your fund a buy at the moment?
Yeah, well, we think the UK small cap sector is an exciting area, and certainly when you look at historical returns, over the last 60 odd years, on average, it's delivered a total return of over 14% a year. So it is a particularly high performing area of the UK market. And the last few years, the market hasn't really gone anywhere, and valuations have become quite depressed. So we think that there's a real valuation opportunity to invest in this area at the moment. And the trust we run has got a very good long-term investment record. We've got a good track record of beating that 14% a year. And also we pay an attractive 4% dividend yield. So, as I said, it gives you an attractive combination of hopefully growth, but also a really good level of dividend.
Cool, thank you. James, what's the sort of sales pitch for Witan at the moment?
Well, I think one of the conclusions I draw from not only the conversation today, but from conversations with investors over the last few months, is the world is perhaps at a crossroads. The investing world is at a crossroads, and so we think it pays to have a balanced approach to global equities. We've got about 40% still in the US, which is relatively underweight versus the main benchmarks that you would follow as a global equity investor. But we do think that the changing dynamics of interest rates, of opportunities around the world, means that the equity market is going to be broader than that we've seen over the last few years. So we've got a nicely spread portfolio across the US. We've got about 20-something% in Europe. As we discussed earlier, a decent weighting to the UK, which, fingers crossed, will finally have its moments in the sun. I'm quite looking forward to, actually, as we go through the rest of this year, I'm quite looking forward to UK politics being much more predictable than US politics, which, you wouldn't have said for a while. So, there's another thing that you could perhaps hang your hat on to say that the UK is well poised to benefit from. So, but really, the idea behind Witan is a one-stop shop for global equity investing. What we haven't discussed at all today is our investments in what we call the direct holdings portfolio, which is our investments in specialist investment companies. They were a drag on performance last year because discounts widened. So we think we've got some really high-quality assets in private equity and biotechnology, and in one or two other kind of trusts that have specialist portfolios that are trading on significant discounts to asset value. So we're hopeful, and it's I think it's quite likely that as interest rates peak and start declining, that the negative influence on those sorts of holdings will be will turn to be a tailwind instead of a headwind.
Fingers crossed.
Fingers crossed.
Nish, you already said, like, you've sort of, the past history suggests that when the cuts start happening, that's when markets start to move. Is that a good reason to be buying your fund now, or are there broader reasons than that?
Well, I think if we focus first on the fund, so the fund itself, it's a well diversified investment trust. It's a single vehicle where you have exposure to smaller companies in developed markets and the fast growth emerging markets. The people behind the product have a lot of experience. There's well over 100 years of investment experience within the team that have been through multiple market cycles. We think the portfolio that we've put together, we're really happy with it because it's a high quality portfolio with high returns, and these companies are trading on really attractive valuations. And then in terms of the asset class, well, the asset class has underperformed for a long period, and there's potential for them to catch up to larger companies. And we know that there's a potential catalyst in terms of rate cuts that are coming that will help the asset class. So that's good. And the discounts. So not only have you got the discount of the companies that are in the portfolio that are on these attractive valuations, but the trust itself is on a discount, and we're buying back stock, which is in itself an accretive action. So there are multiple levers, if you like, for generating a really good return, and that's something to be really excited about.
Great, thank you. Jonathan, James mentioned elections. We'll come back to maybe the US one in a minute, but with just thinking about the UK, for example, do you think the UK election is a non-event as far as markets concerned, or do you think it's actually could be quite positive?
Well, I don't think it's a big deal. I think certainly if you believe the opinion polls, the result of the election is fairly certain. So you would imagine that would already be in share prices if there was going to be a dramatic impact. And when we look back at the previous Labour administration, that was actually a pretty decent period for markets. So I don't have any great fear if there is a change of government. And certainly that they're trying to look business friendly, and if they're good to their word, then I don't think it's going to make a huge amount of difference to UK markets.
Okay, fair enough. Thank you. James, what do you think about the US election? Is that something that might have more of an impact?
Yeah, it's a really good question, James, and frankly, God knows what the answer is. I think actually going back to the UK quickly, I think the one thing that both parties are focused on, and this would be absolutely tremendous for UK equities, is improving the savings culture, and that's so important, educating people about savings and investing. US election, look, I just think it's such a sorry world where. In fact, I was at a conference yesterday. You were there, James. At a conference yesterday when John Sopel was talking about the US election. He said it's such a sorry world that you're choosing between the 79-year-old, is it, and an 81-year-old, and that's the best that a population of 300 and something million people can come up with. A Biden victory would be probably the most sane outcome. A Trump victory, it could well be positive for equities because he loves equities and he loves cutting taxes, and but the uncertainty that goes with it could be, I mean, without precedent, and particularly when if you look at some of the things he says about NATO and about Putin and about Taiwan, there's going to be a huge amount of uncertainty if he's elected. But generally, he was decent for equities last time. Biden's been good as well. So just a lot of uncertainty, I think, is the summary.
Fair enough. Well, let's not get too depressed. I think actually the summary of what we've been talking about today, it does all sound like things are moving in the right direction, that there is sort of hope of upside for all three of your portfolios. And it'd be interesting to see what happens. And as always, we'll follow it closely and maybe get you back on another time and see how things went. But thank you very much for your time today. And I hope everybody found that useful. Sorry if there were questions that we didn't get around to, but thank you very much. And we shall talk to you again soon. Now, let's go back to the presentation again. So as usual, there's the legal slides that are very important. We're not trying to sell you anything here. We're just trying to inform you. We'll be back obviously next Friday. It's Easter, but the Friday after we'll be talking to Life Science REIT. And we've also have, because it's the first Friday in the month, we'll have Ajima Hatti on talking about what happened to markets over the course of March. And then it's the lineup going through there for the next few weeks. 3rd of May, we did have Will Fulton on UK commercial property. It looks like that fund won't exist by then. It's just the nature of the markets as we stand then. It looks like it is going to get taken over by Tritax Big Box REIT. So we'll see if we can maybe get one of those on instead. So thank you very much for your time today. Hope you enjoyed it and hope we'll see you in a couple of weeks' time. Thank you.
Thank you.